Welcome to Mark Arnold's Finance. We just finished week 1 of 2 big earnings weeks, and 4 of my companies in my portfolio reported earnings. I want to cover if those companies beat or missed expectations and give you some review on these companies based on information I've researched from their earnings. So this will be a great video. Be sure to stick through till the end. And if you're new to my channel, be sure to subscribe. I'm somebody that is very transparent. I show my portfolio performance with every single video, and I also share the good and the bad, not just the good like a lot of channels do. And so this is where I think this helps all of us grow and learn together. So be sure to subscribe, check out my channel, see if you like it, and thank you to all those who have subscribed. Let's dive into my portfolio performance, which has been improving over time. We'll see here I'm in the red, 7.29%. Now last video I did, I was down about 8.5%, and then before that it was close to 11%. So we're gradually getting better. And it's earnings that are helping propel this market up. There's a lot of positive from this first earnings week, and so that's what's making things go up. And one of the companies that went into the green is Microsoft. I was able to add heavily into this company while it was in the red, and so if it goes back into the red in my portfolio, I'll just keep adding heavily as I want to get this to a substantial size in my portfolio before I cut it off and then focus on other companies. But let's now talk about the 4 companies that reported earnings. I want to show you here in my portfolio who they are, where they're at. One is Bank of America. They reported, you'll see here, they're up 34.5% in my portfolio. Another company that reported earnings was Ally Financial, and you'll see here they're down 20% in my portfolio. The third one was Johnson & Johnson, and you'll see it's in the green by 10.81%. And the last one to report earnings was AT&T, and you'll see here it's currently down 22.87% in my portfolio. So let's get started with these companies, but I do want to show you this. With each one, I'm going to show you this chart and reveal it one by one, what the estimates were, and then reveal what the actual numbers are and see if they beat or miss. So we'll do this with every single company, and we're going to start with Bank of America. We'll see here that they had an estimated earnings per share of 77 cents, and they beat at 81 cents. And then they had an estimated revenue of 23.57 billion, and they beat at 24.61 billion. So that's why I highlighted the numbers in green, because they were both a beat, which is fantastic. Now, Bank of America, looking into their earnings, banks are producing more revenue as rates rise. So they're taking in deposits and making loans and profiting from that activity. Also, their clients remained resilient with strong, although slower growing spending levels and maintained elevated deposit amounts. So this is a sign that the economy is still strong, still hot. So that is kind of a signal that maybe Jerome Powell might keep raising rates at a higher level. But this is just strong for Bank of America, which is why it went up, I believe, over 7%, and so it's doing well. Now, it grew loans by 12% over the last year. Net interest income jumped 24% to 13.87 billion versus a 13.6 billion estimate. And investment banking revenue did fall 46% though to 1.2 billion, which that's the economy we're in, and I don't think anyone's portfolio has done well over the last year that I know of. I'm sure there's a few that have been able to get through this with some pretty good profits, but they're probably very focused in their portfolio on 1 or 2 companies because the broader market has just gone down. Now, they booked 898 million provision for credit loss, so this signals a harsh economic outlook because they're preparing for more people to default on their loans and be delinquent. And so this is just something that they're preparing for as a bank. So they did beat on their earnings and their revenue. And I do want to note that JP Morgan and Wells Fargo also did well on their earnings too. So the banks are holding up very well. And for me, Bank of America is just a very solid, safe play. Now, I am up over 30% because I got in this company at a very low cost average. So it's hard for me to add to this company. I wanted to add when it hit below $30, but it barely went below. I didn't really have the funds, so I thought I'd wait and see. Now it's back up, but if I do see it go below, I will add because I do like Bank of America. I think it's very solid, healthy company, and so that's where I sit with Bank of America. Now the next one was the kind of ouch of the week, and that is Ally Financial. They did not beat. So we'll see here that they had an estimate of $1.68 of earnings per share. They came in at $1.12. They had an estimated revenue of $2.16 billion, and they came in at $2.02 billion. So they missed on both earnings per share and revenue. So wasn't a good thing. The stock market did not like it, and it sent it down in the red. So Ally is preparing for auto loan losses, and their probable loan losses rose, as well as their delinquencies, as well as their past due payments over 30 days. So they're just having a lot of struggles with their auto loans, but Ally does say that the auto lending space remains resilient. So I just think they're expecting some strength as far as, though they're seeing these early signs, I think overall it'll stay within their range is what they're saying. So they are expecting temporary pressure from the increase in short-term interest rates. So meaning that, people are struggling with these higher rates and affording their loans. They did have a provision for credit loss that increased from $362 million to $438 million. So like Bank of America, they're putting money up saying we're expecting delinquencies, we're expecting people to default on their loans. And though this is a much smaller number than Bank of America, they are a lot smaller of a bank. They also booked a $136 million impairment on its investment in Better.com to reflect conditions affecting the broader mortgage industry. So basically, they marked down the value of this investment of theirs in the digital mortgage provider space, and that's what this company is. This Better.com is a digital mortgage provider. So they are foreseeing some issues with the mortgage loans in the future, and specifically with this company that they're invested in. I will note that the CFO did leave. It did not say why, but that's something just to know as an investor. Now, the CEO said they are prepared for a recession, which they're expecting. And they said they have great coverage ratios and they're very strong, as well as their coverage overall remains healthy. So they are financially prepared is what his message was. Ally also said that they like the loans they're putting on their books right now and think that they will prove to be very profitable over time. So they are prepared for volatility, as they mentioned. It's just hitting harder and sooner than they expected. And this threw the market off guard, which is why it sent their stock going down pretty massively. So Ally is still profitable and they still have healthy levels of capital. So I do agree with Ally CEO that they are prepared for a possible recession in hard times. And I will note this, I bought into Ally recently. I did a video on it and I was well prepared for something like this. I only put a small portion of my money into Ally. I will say the failure on my part was that I was impatient. I was wanting to get in below $30 and I got in about $33. And that's, I think, common for a lot of investors. We get impatient. We just want to buy in. Even though we marked a point well ahead of time, we just get impatient. So that was my bad. Regardless, I still think I got in at a great valuation. I will just average down. But I knew that there was no more stimulus. So people don't have that money more to just go spend on getting vehicles. They're, any kind of loan payment, stuff like that. Inflation is high, so the cost of everything is going up, which means people have less money to put towards things like auto loans, mortgage loans. So they can't afford their current loans, nor probably get new ones in the future. Also, you have the semiconductor shortage that happened, which did increase the demand for vehicles, and that's starting to improve. So demand for vehicles is starting to go down. Cost of vehicles is starting to go down. So overall, with Ally Financial, I do not see any major red flags that would cause me to sell. I am going to average down because I do think they are prepared. They have low debt. This company does have good financials still. And so I will just average down and keep an eye on this company over the next couple quarters. But I was prepared for this to happen because I did mention that they're big risk because they are highly focused on auto loans, and that's the big risk with Ally, and you just have to know that. And so that's something I was well prepared for. Based on my research, I feel they fell significantly to a point where I was comfortable adding some level of safety. I should have listened to myself though and got under $30 per share. Regardless, I will average down. I think long term, this will be a great investment. So we will just have to see how this plays out. Next was Johnson & Johnson. So we will see here that they beat on both earnings per share and revenue. So the estimate earnings per share was $2.48 and they beat at $2.55. The revenue is expected to come in at $23.4 billion and their actual revenue came in at $23.8 billion. So this company beat. That was great to see. I think Johnson & Johnson is a fantastic company. So they have different segments of their company. So they have the med tech segment. So their medical procedure volumes, they stated, are back up. Overall in the market, medical procedures are back up, leading to an 8.1% sales increase in Johnson & Johnson's medical device division. Also, their consumer health sales increased 4.8%. Their pharmaceutical sales grew 9.2%. And they announced a $5 billion share repurchase program, which is great for us investors. That means they're not diluting us, and we get more ownership of this company per share we own. They are maintaining full year guidance overall, so that's a great sign. They're not, decreasing or lowering their guidance. And then you got to note with Johnson & Johnson, they are spinning off that consumer health part of their business, and the new name is interesting. It's going to be called Kenvue, Kenvue. I think it has some special meaning. When I was researching it, the first part, K-E-N, meant something, and then the V-U-E meant something else. Anyways, Kenvue, that doesn't really roll off the tongue really well now, but maybe it will once we get used to it. But they're spinning this off mainly due to all of their lawsuits in that part of their segment of their business, the consumer health, which will help to protect the other parts of their business. This spinoff will occur November of 2023. Now, I will mention, we saw their MedTech segment up 8.1% in sales, pharmaceutical up 9.2%, and the consumer health was up 4.8%, about half of what those others were. And Johnson & Johnson did say we expect the consumer health to be a lower growing part of our business, and it's proving to do so, which is great because what Johnson & Johnson said is turning true. So in the future, they will just be focusing, once they spin it off, on pharmaceutical and MedTech type of portions of their business, which I'm excited for. I will have to decide what I want to do with the consumer health, if I want to keep it or not. But I'm a buyer of Johnson & Johnson. I haven't added in a while, so I need to start looking at at what buying point I will do. But I think this is just a solid company that should be around the rest of my life, and a solid dividend payer. It's a great company overall. It does have its lawsuits, but it's been handling them real well so far, and the spinoff is a huge positive for them. So I like Johnson & Johnson. Glad they beat. That was a good thing to see as a company in my portfolio. Lastly, the big surprise to me was AT&T. They beat on both earnings per share and revenue. So their estimated earnings per share was 61 cents. They came in at 68 cents. Their estimated revenue was 29.8 billion, and their actual revenue was 30 billion. So they did beat. I got a lot to say with AT&T, but those were great, but there were a few negatives. So their reported free cash flow came in at 3.8 billion, where the estimate was 4.4 billion. And they changed their guidance. They reduced their free cash flow guidance to 14 billion from 20 billion, mainly because of some big expenses in the fiber 5G rollout of stuff. So that's kind of a little bit of a negative. Also, their debt reduction is slower than the company wants it to be. So they're reducing their debt slower than expected. Now, at December 31st, 2021, their debt was at 151 billion, and now it sits at 124 billion. So it is going down each quarter, which is a great thing. And this is the key to this company doing well, is them continuing to reduce that debt. This is the big, problem for them. And if they can continue to do this, this company is going to continue to do well. Now, their fiber build out is expensive, and it is a huge part of their strategy. So that's why the free cash flow, I feel, is being lowered, their guidance on that. Now, some more positives besides the beat on earnings per share and revenue is they added 708,000 phone customers versus the 552,000 estimate. That was a big surprise to me, actually. I feel like this company is more of a slow growth in that area, but they beat pretty significantly, so that's really good. They added 338,000 fiber broadband subscribers versus the 330 estimate, so 8,000 more subscribers. So that's a good sign. So I will say this with AT&T. I've been putting videos out about AT&T for a long time now. After they spun off Warner Bros., their entertainment side of stuff, and started saying they were going to focus on the debt, I said, this is going to be the turning point for AT&T. This will, at some point within the next couple earnings, I feel, start to turn things around, and we'll see AT&T start to go up because they've been downtrending for such a long time in their stock price. I just knew that this was the key because they're going to focus on what they do best. Management made some horrible decisions in the past. I feel they're finally making smart decisions. So I do think this is just the beginning of AT&T starting to uptrend. Now, this is a slow growing company. I feel I will be in the green at some point. It's got a ways to go, so I got to be patient probably for a few more years. But I don't know. I probably will sell this company unless if there's something fundamentally that comes about that I really like. But because I have such a long horizon to retirement, I just don't think this is the stock for a long-term investor. It's a good income investment, and I think if you're getting in right now, your stock will appreciate the price of it, what you hold. But yeah, I just think it's a slow grower, but this is what I've been waiting for, the turnaround, and that's what I think it's finally starting to do. So we'll have to keep an eye on this on the next few quarters and see how things turn out with AT&T. So there you have it. Looking at this chart, the only company that missed was Ally. All the other three companies beat on both earnings per share and revenue. So this makes me happy with overall because Ally is new and I did expect this. It's just hitting harder and sooner than expected, but I will still be adding. AT&T I probably won't add. I'm just going to wait till that hits the green. J&J I want to look into adding, and Bank of America I'll add if it gets below $30 per share. So we're still in volatile times. Who knows what the economy will do, what the stock market will do. So I'm just prepared to keep buying while we're in this downtrend because I feel this is the accumulation time. This is time to be bulking up on your high quality stocks. And so let me know what you're bulking up on. Let me know what you thought of these earnings of these companies and if you agree with my outlook on them. Should I be selling any, buying any, holding? I'd love to hear your opinion. I let you know mine. So thank you guys so much. I hope you like this. I'll do another video at the end of next week after the big earnings week. Next week is big tech, so that'll be very interesting. And that can definitely send the market up or down in a big way. So have a great day, everyone. Be sure to subscribe, and we'll see you next time on Mark Arnold's Finance.